Hi there, this is Chris from MoneyHub, and this video looks at the Morningstar KiwiSaver for March 2023. So Morningstar helpfully issues these reports every 3 months, which is great, and they're free to download. I've linked this one, which I'm going to talk about in this video, down in the description. If you have any comments, any questions, please leave them down below, because this really helps us through our ongoing research to make sure that we're covering everything in subsequent videos. What I'm going to do is walk you through this PDF. It's quite big, but I'm going to make it real simple. And this way you can see what's going on within the market in KiwiSaver. It's clearly very large. There's about $92 billion invested. And this is going to really break it down and make it understandable and show you basically where the money is and what's happening. So let's just go straight into it. And first up here, there's just a bit of an introduction. Nothing too much crazy, but they're going to talk about, because obviously this is the first report issued since December. They're going to talk about things like Silicon Valley Bank, and they're going to talk about changes of interest rates, which are all happening. They're going to talk about the performance of the NZX. And this is, of course, influencing KiwiSaver returns because lots of money goes into the NZX. They're going to talk about Australian shares, and then they're going to talk about investment property, and then they're going to talk about the individual fund managers and things like that. What's quite interesting is you can see the breakdown of where all the money is in from the different schemes. So there's just over 20 schemes in New Zealand. You've got your big ones like the likes of ANZ. You've got your challengers like Simplicity, Pathfinder, Juno, Kernel, and things like that. But you can see that from that 91.9 billion, the ANZ leads the actual chunk of that with 18.7, followed by the ASB, which is 15.7%, and then BT, which is Westpac. That's holds down third, and then you've got Fisher, and then you've got Kiwi Wealth. And from those six, around 69-70% of the money is within those six schemes, which is quite a lot. But I mean, large doesn't mean that it's the best, and certainly the well-performing schemes like Milford, they sit with outside that, but at the same time, they have very strong results. So let's go straight into it. And what I'm going to do is go straight into the money. So what you can see here is going to break up everything through different, like categorizations of where the money's at. So you can see from all of the money in KiwiSaver, which is about 91.9 billion, which I just mentioned. Most of it is in growth funds. You can see here it's about 30, and then sort of balanced funds, which sit between kind of moderate and growth. So a little bit of shares, a little bit of fixed interest, but kind of, sort of balanced, as the name sort of implies. And then on the outliers, you've got your defaults, which I'll talk about in a second, and you've got your conservatives, which are very, low risk, and then you've got your aggressive funds, which are high risk. And so what you can see here is that from the 6 government-appointed default schemes or funds, you can see one from BNZ, you can see one from Booster, Kiwi Wealth, Simplicity, Superlife, and Westpac. These are all performing. You can see 3-month performance, and you can see 1-year performance. They've all, performed negatively there. If you are in a default fund, there is quite a lot of money in them. You can see around $3 billion. Please consider changing that, because default's really just a holding ground for people who are looking, or sorry, should be in other funds. They're low fee, and the design is just to get, and of course your KiwiSaver scheme is probably contacting you, trying to get you out of it and put you in a more appropriate fund. So you can see here that the returns, they're fine, but it's still a lot of money. It's still around 3.5% of the total, 3.2% of the total KiwiSaver money is sitting here, and arguably not properly being, returned compared to what the other options are. Right, so if I just go straight into it, and I'm going to go and talk around conservative funds, because whilst there's not a whole bunch of money in them, it kind of just gives us an introduction. You can see here that we're going to look at the 3-year returns. So if you go down, you can see 3 months, we'll go across, and 1 year, you can see 3 year, you can see 5 year. And so we'll look at the 5-year and what this means, these numbers. So the first column is going to be the return, and then that's as a percentage, and then you'll see this ranking. So if it's 14, that means it's the 14th highest performing fund. So what you're looking for is like 1 and 2 and 3. So we'll just cover the first 3, but you can also have a look at the 4 and 5 when you download this yourself. So number 1 performing with sorry, if I go back to the 3-year, the number 1 performing with an average of 3%, that is going to be the Key Street Conservative Fund. And then you can see here that the number 2 performing is the Milford Conservative Fund. That also has a return of 3%, but it's due to rounding. So there'll be a clearly, fractionally, Key Street's higher performing. And then if you also look at the third top performing is the Key Street Income, that's also 3, but that's going to be lower than Milford due to this rounding of it. So that shows you those, but I think what we want to really go in is to see is where the money's at, which is the growth funds, which is where we get most of our questions around. And what I'll do is I'll go straight into these. Now, you may look at these and think, well, if there's so many KiwiSaver funds, why are so few in growth? Well, the answer is they're actually, they may be growth focused, but they're not grouped as growth. They could be grouped, they could be grouped as like Australasian shares. They could be grouped as New Zealand shares or something like that, or possibly miscellaneous, which I'll get to in a minute. But this is where, the core growth funds are. And if we look at our 3-year return, we can see that the Milford Active Growth is coming in with 12.8%. And then second to that is the Pathfinder Growth Fund, and that's 11.8%. And then coming in third on that is the ANZ Growth Fund. So the banks get a bit of a hard time, and people seem to think there seems to be a misconception, or arguably there is some truth in it, that they're not so innovative. But at the same time, the returns can be quite strong. And of course, KiwiSaver is a long-term investment. What's quite interesting to know is that you can see 3-year returns, say, for example, Juno Growth, and you can see that it's like number 19, so it's the 19th best performing. But then if you look at its 3-month, then it's going to be, in this case, it's the best, like it's in the number 1 spot. So when you are comparing, please look at long-term data. People shouldn't be making decisions, I don't think, on 3-month data. It's not very rich. It can move around quite a lot. And certainly, as we see, and I'll just take you back to something which is quite interesting, at the top of the report, you'll see, where does it say it? There's some interesting sort of analysis on the top performers. So they do a 3-month performance and they do a 12-month, and that's interesting. So you can see in the space of 3 months, the Cora, also this fund called the Cora Carbon Neutral Cryptocurrency Fund, that has gone up 73.1%. But that doesn't mean it's going to be going up, 73.1% in the next 3 months. That's just what it's reported. And then you can see that the lowest 3 months performance is 4.8%, and that's from the Super Life Australian Property Fund. And then you've got your highest 12 months, which is like it's the Invest Now Fund for the entities like Global Long. I think I can't remember actually what that fund is. There's many Invest Now there's many Invest Now KiwiSaver funds. And then you will see that, the lowest 12-month performance here is going to be the Nico Arc. That's the Disruptive Innovation Fund. That's been launched for about 2 years, and it's lost a lot of money. And it's tied, or it follows the Arc Innovation, like this ETF product on the US markets, a woman called Kathy Wood. And basically, they continue to report losses there. So I think it's worth knowing that, this sort of exists to see a snapshot of all the funds, like from it, like every single sector and every kind of like investing strategy. You can see that's the top, and that's the lowest. But I really wouldn't make any investing decisions based on that. It's not wise, and there's no guarantee that there's going to be, continued performance. But what you can also see is that there's 281 funds, and there's 23 different Kiwi schemes. 23 different KiwiSaver schemes, so quite a lot. So just going back now, having looked at the growth, I'll just go into something called the aggressive funds. This is just worth knowing if you're looking at a growth fund and thinking, well, I might be interested in going a bit more aggressive, making my money work harder, risking a bit more. What you can look at is the returns. So in here, you can see that, the Milford Aggressive, so all of these aggressive funds are very highly focused in investing in shares. That's their strategy. It's not so much, a little bit more in fixed interest, a little bit more in term deposits and stuff like that. No, but these are basically all in shares, and they're all sort of picking shares, or their investment managers are, to hopefully beat markets and really return lots of investment money to their KiwiSaver members. You can see here that the Milford Aggressive over 3 years has gone 14.5%. Now, if I compare that to where the Milford Active Growth Fund for 3 years, you can see that's actually 12.8%. So here, the aggressive fund has beaten the active growth, which you would probably say makes sense, but sometimes it's not always the case. And so you can get, so in this case, you can see that in the 1 year returns, they're all negative. The top performing was again Milford Aggressive, and that was negative 1.8. But then you've got negative sort of 8% returns in some schemes as well, and negative -5. So it's basically worth noting that these funds, or these these returns exist for your sort of observance, and it's good just to get familiar with them. But as I say, most people are usually switching within growth funds, looking for new opportunities or a new fund, and this is the table that you really want to be understanding and just getting your head around. And then we've got a whole bunch of reviews which talk about the different different funds, different schemes. Now, sort of carrying on here, you can see, well, if there's so many funds, if there's 280 funds, why am I only seeing a handful of growth funds, around 30 of them, or just under? Well, the answer is because there's lots of different classifications of these KiwiSaver funds. So you have a whole bunch of cash funds. So these are funds which just invest in cash, low risk, and you can see that in the 3 year, the average returns here has been 1.7%. Someone's made a return of 1.3%. That was the Super Life Cash. You think cash would make consistent returns, but it does not. So worth knowing that these are the cash funds, and probably is arguably the lowest returns long term. Of course, if you saw bad capital markets, bad share markets, then growth funds would be rocky. But long term cash funds are designed that way. Now, fixed interest, similar here. There's a whole bunch of funds. International shares. So these are funds which don't follow the whole growth process, so the whole growth model or the whole aggressive model. They're just putting all their money into international shares. You can see that top performers here for 3 years are going to be the likes of the One Answer Sustainable International Shares Fund. Following up with that, you've got a Super Life Fund, and then like another Super Life Fund. So that's worth kind of comparing if you are interested in, just want to be in international shares. Then you're not looking for a growth fund. Arguably, you're looking for an international shares fund. So that's some opportunities there. And then if you go into property funds, of course, property over the last sort of 2022 has been quite rocky. And you can see that all of the funds here have lost money in the last 3 years. So that's the 1 year return. And sorry, strike the 3 years, that's a 1 year. And you can see that the best performing property fund that made a loss of 13.7%, and that's an InvestNow SALT funds, enhanced property funds. So InvestNow is the scheme that you invest in, but actually they put the money with a company called SALT funds, which is it's like a Milford or a Fisher funds. And then you can see that the worst performing here is a negative 23%, and that's from the One Answer International Property Fund. So that's sort of, so it just helps to get familiar with all of these different sort of funds and different categorizations, so that you can quickly understand where your money's going if you're looking to move it around. And then once again, you've got all these Australasian equity funds. So these are a whole bunch of super lifes, which is effectively index trackers. And then you've got your kernels, which again, if like this is following the NZX 20, and then you've got some small cap, and then you've got some, you've got a whole bunch of different things. Sometimes it's strange. You think, well, why is the Cora NZ Property Fund listed as it's listed as like Australasian equity? Like, why isn't that in like properties? And the answer is, well, you'd have to ask Morningstar, but that's how they've grouped them. I don't know the answer, and there's so many funds to kind of keep track of. But that's just some things that I do notice sometimes when I'm reading through these. And then finally, you've got your miscellaneous. So miscellaneous doesn't mean that it doesn't, it's not good. It just means that they don't have a Morningstar category. And you can see some of these are being, some of these have had like very high returns. So you've got like the Booster Geared Growth Fund. So that's designed to borrow a whole bunch of money and go and invest it. So that's kind of where it gets its name from, geared growth. And then you've also got funds like, the Cora US Equities Fund, which is, you can see here, small, but, making 14% across 3 years. And then you've got your super life indexes too, your super life US 500, which is the S&P, and then, sort of various other funds there as well. So this is kind of the overview, which I wanted to summarize. That it's just really like the way to get familiar with everything is to go into the detail. Don't be afraid of the tables. Just embrace them. They're phone friendly. Can you believe it? But they are. And really just get an understanding of what's out in the market. And you can see here that the largest scheme is the ANZ, the largest KiwiSaver scheme, and then the second one is the ASB, exactly as the table described up above when I first narrated it. And then you've got your smaller funds like Nico. So Nico AM, sorry, is one of the smaller schemes. It's kind of alongside Kernel, which is the smallest at the moment, but it's quite new. So that's 40.6 million under management. And then you've got your likes of you've got likes of Cora at 65 million. And then you've got, popular ones like Simplicity with 3 billion and all of that. I mean, you can just have a look through and see, where the money is at. That does not mean that, the big ones are better and the small ones aren't. This is just more of an observation of, it's quite interesting that, they've jumped up a lot, or, the ANZ is still number one. It's probably going to be number one for some time, just because it's so big to start with. But it's just good getting some sort of familiarity around this. And what you can see is that, I don't know if this is interesting, but it's worth noticing. It's worth pointing out is that Morningstar has estimated how much money is received in fees from the different providers. So this is kind of wild. So $171 million estimate from Morningstar is going into the ANZ for managing their scheme. And then, other ones, if you looked at Milford, that would suggest that from its 6 billion under management or thereabouts, then there's fee revenue of about 68 million. And then once again, if you look at Simplicity, which is half the size of Milford, but you can see that it charges lower fees because it's only got $9.3 million of fee revenue estimated coming in versus Milford's 68. So it's half the size, but it's about 1/6 or 1/7 almost the fees coming in. That's not a shout out to Simplicity or Milford. That's just an observation, and it's worth noting that some of them are quite large. Some of these schemes are quite large, but no one's ever heard of them as many. Well, sorry, as as widely as they could be. So, for example, MAS, that's like a quiet one, but that's got like 1 billion, so that's obviously quite large. The 14th largest, and then the likes of Generate, which is largely sold, as far as I know, but this isn't a comment of yes or no. It's through brokers and through advisors. That's 3.8 billion, and some other ones. Mercer, once again, quite broker, quite historic, one of the earlier players. And then you've got your likes of Pi Funds, which is actually trading as Juno. So sometimes the names don't quite correspond. And then you've got FANZ, which is sold through SBS and largely to Southern Building Society clients. So this is not me just naming things for the sake of it, just trying to get more familiar with who these people are. But it's really worthwhile to go through these reports. They come out every 3 months, and you can see some of the assumptions which Morningstar's listed there. But it's really, really helpful because I really want people to understand the stuff as much as they can, and don't be put off by the numbers or the charts or any of the words. Just read it through, make a cup of tea, and just get basically just get familiar with them, because we're relying on KiwiSaver as a country to support us in our old age or when we retire. And ultimately, if this is going to be a significant investment for you, it's really going to help just to read the information that's coming through. I was worried that Morningstar may stop publishing this for free for people because they did take away some of their other tools. So far, that does not seem to be the situation, which is really, really helpful. But should something happen in the future, then I will be paying for access via Morningstar, as long as it's reasonable. The quote I got was, and then publishing, a commentary on it pursuant to the license which I pay for. So thanks very much for watching. Please do leave any comments down below. We want to know what your thoughts are. How can we improve this? We want to know questions to basically make sure that future guides and future overviews are as comprehensive as they can be. So thanks very much for watching, and best of luck with your KiwiSaver investigations.